use to improve your tax compliability?
Compliance. Tax compliance.
Compliability. Yes. I've just made up a new tax compliability.
Listen, maybe that's a new word, eh?
It is.
Just give us the definition.
Registered trademark. Compliability.
Yeah.
Is that you are so tax compliant,
right?
That your compliability is like the credit in advance. You know,
you are the benchmark.
You're the walking example of compliance. Compliability. I told you, new word. Anyway, facts about tax. Today we are talking about deductible, the deductibility of business expenses.
Yes, we are.
And that's an important one because as time goes, people are either going to be self-sustaining entrepreneurs or going to be working for companies which invite a lot of travel and things of that nature.
Yes.
And how much of that is deductible, how much of that is taxable, how they could go about it. So these are practically important things as well.
Yes,
Let's get straight into it.
Sure. So in the context of a company or in the context of a business, there are a wide range of expenses that a company or a business owner could incur. And obviously the legislatures can't possibly go through the whole list of what may or may not be deducted, but there are obviously always guidelines to what you can deduct. So the section in the Income Tax Act that actually deals with tax deduction gives us a very wide definition of what you can deduct, and it reads that it is expenditure and losses actually incurred in the production of income.
Okay.
And I want to break that down into three sort of sections that we're going to talk about today. Expenditure and losses.
Okay.
So an expenditure is exactly that, an expense. You get an invoice or you get a bill and you make a physical payment to that effect.
That goes out.
Okay. That is an expenditure and that is allowed as a deduction.
Okay.
Now, what are losses? Because it's very vague and it's very wide.
Are those like bad debts and things of that nature?
Bad debts, stock losses, and barter transactions. So if you've got a cell phone and you want to buy a Mercedes-Benz, silly example.
No, it's getting there. with these new iPhones.
Right?
Second-hand Merc.
Yes, it could actually
because there's some cell phones now which are retailing for about 75K.
Yes.
So it's not unrealistic. 2 years ago, I would have thought, look, you're being silly. You're being silly. But today, yeah.
So if you trade your cell phone for a car or you've lost something, you haven't lost physical money out of your bank account, but the cell phone that you've lost has a value.
It was an asset.
And it has a value and it's now no longer in your possession. It's no longer yours.
Right.
Then the cost of that can be allowed as a deduction.
Okay.
So it goes that deep and that vast.
And obviously they calculate it on a per case basis on whatever that was bartered, what its depreciation value was and all of that.
That's correct.
Right,
yes.
right.
And then the second component is where we're going to go into tax law because there's a lot of gray area and a lot of room for interpretation. So actually incurred. What is actually incurred? Remember our sentence reads, expenditure and losses actually incurred in the production of income. So now we're looking at... It must have
happened in that financial cycle.
In that financial cycle, yes. But it must be actually incurred. So what does actually incurred mean? Actually incurred means that you've actually incurred an expense or you've incurred a loss. You've got an invoice to back up the fact that you've actually incurred an expense.
Okay.
You've got a contract in place to sort of say this is the actual eventuality that happened. But what has been interesting in case law is that something came up a couple of years ago where it was stated that actually incurred does not mean necessarily incurred. So you can have excessive expenditure, you can have extravagant expenditure.
Sort of like certain municipal behavior.
Yes.
I'm just,
it is what it is.
It's a practical example because we see it. We see them. I mean, even when the mayor reports, it says, I want to clamp down on excessive spending.
Yes. So it's not necessarily expense. So you can't look at two businesses and say, well, this business did not pay X amount of money for the same goods or services.
Right.
Why are you then? So it's actually incurred. So if you get an invoice for 100,000 where somebody else managed to get it somewhere else for a fraction of the price, that is neither here nor there, but you actually expensed. That was your actual expense.
It's the same as what you pay for a pie at a normal grocery store.
Yes.
And what you'd pay for it on the beachfront at the restaurant. The same pie.
It's
which costs you 25 rand at the store will be a good 95 rand.
That's exactly.
And well, if you can take it, or we kind of could use the space to put somebody else.
So I'm going to look at a case. Again, the cases that we look at are quite dated. It's a 1936 case called Port Elizabeth Tramway versus the Commissioner of Inland Revenue at the time.
That would now be Transnet.
Would it?
Yeah.
I was actually trying to think of an example.
It would be Transnet now, which took all of them under the umbrella.
Okay.
Yeah.
That's a very interesting thing. I learned something new today.
Well, remember that we don't have many private railway lines.
Yes.
It's because Transnet kind of scooped all of them up and said, look, the state would like to take care of this part.
Okay.
Yeah.
So that many years ago, there was a private railway that was running. It was called Port Elizabeth Tramway. And one of the trams that were traveling, they derailed and they went into some buildings, a hotel, in fact, and a jewelry store that was in the vicinity of the tracks. And what that hotel and jewelry store did is they sued the company for damages. And the jewelry and the hotel won that civil suit, and PE Tramway Company had to pay those damages. Now, PE Tramway tried to claim those damages as a tax deduction, and that's where now the Revenue Authority came in.
Like, said, hold on, bro. What do you mean?
Yes. And so they went through all the internal processes, trying to argue this in objection and appeal. And it eventually went to court, where the court found that it was a bona fide accident. The tram driver was actually in the action of driving the tram in the production of income, and the damages was sustained as a result of a pure accident.
Yeah.
And then the company was then allowed to claim the deductions as, or rather claim the damages as a tax deduction.
And that set a precedent, obviously.
That set a precedent, which a couple of years later, in another case, another taxpayer tried to argue based on that precedent set by this case. So we've got now a 1946 case, about almost 10 years later, an individual, or rather a company called Joffe and Company. What had happened was this company was an engineering company, and they were in the business of setting up steel structures, or rather cement structures, but infused with the steels to make it stronger.
Okay.
Yes.
Okay.
And there was found to be negligence in the manufacturing of this
of this mix of theirs.
On this mix, yes.
Yeah.
And then what happened was the structure collapsed and fatally injured one of the workers. So the family of one of the workers then sued the company for damages. And then this company wanted to use that precedent set in the PE Tramway case to say, no, this was in the production of income, and they wanted to claim those damages as deductions, as was the case in the previous case that we looked at. And going through the facts of this case now, the courts found that there was indeed negligence with regards to how they mixed their materials, and negligence in itself is not in the production of income. You don't go into business to be negligent and to possibly fatally injure people, which is what happened now.
And it's also your responsibility to protect
Yes.
the safety of the employees.
That's correct.
Right.
So those two cases looked at side by side just shows you the sort of very thin line in terms of you can't say because your circumstances are so very similar to the other person, the courts will dig deep into your specific circumstances. So it is literally on a case by case analysis. You can't just follow what was done before or follow set precedent.
And the precedent is a guideline, but it's not absolute.
It's not absolute.
Right.
So the courts will dig deep and look at the facts of your case.
Okay.
And then when we look at the other component with regards to tax deductions,
yes,
we see that it must be in the production of income. So what exactly does that mean? So if we look at the tramway case again, where the train derailed and hit the hotel and the jewelry store.
Why couldn't I have been? I'm just. Look, granted, we probably wouldn't be having this interview now. I'd be a bit much older and not as energetic.
Well, wait until I discuss what actually happened to the train driver, and then we'll see if you want to be in those shoes.
This I need to hear.
So the train driver unfortunately passed away in that incident, and then the family of the train driver sued the company. Remember, there are now two suits that we're looking at.
One of the
hotel
hotel/jewelry store.
Yes.
Who are claiming against
their property.
Yes.
And now the family of the deceased train driver who actually passed away in that incident claimed damages. And the court, because it had found that it was a bona fide accident, awarded these damages to the family. The company then again wanted to claim these damages, now second set of damages, as a tax deduction. And they then had to go and argue that again. And it followed then the course of the previous judgment because it was a bona fide accident and the driver was in the course of driving the tram in the production of income.
Yeah.
Yes. So the deduction was then allowed.
Like if I owned the jewelry store though.
Yes.
I know. I'd be like, listen, I had just put my new shipment. It had just arrived from Kimberley. I was in the process of putting it in inventory.
Yes.
I saw a train coming towards my.
You saw your life.
I don't know. I don't know where my goods are, but I need assistance here. I need.
Yes.
It probably wouldn't work because they'd be like, yeah, but where's your receipts or something?
Yes.
Like I just came from Kimberley, dude.
But there must be a paper trail, though. How can you buy a whole set of jewelry and there's no paper trail?
There is a paper trail. It was damaged in the accident.
And back in those days,
damaged. If you lose your receipt, there's no reprint.
And back in those days, I mean, the technology at the time in 1936, it's not like you can whip out an email and say,
like, listen, let me just call Banato quickly. Yeah. So
to bring it closer, because we're looking at all these old cases, I had a thought as I was preparing this content. What sort of example can we look at that is more relatable?
Right.
And I had a thought about where we are as the world, actually, as a globe. We are in the midst of a global pandemic. Businesses have had to shut down. Those that are still operating are operating under very different circumstances than we were 2.5 years ago.
Most have downscaled.
But what I want to get to is PPEs. A company would need to have now this additional expense, which is sanitizers, masks, and fumigation every now and again.
Gloves depending on what the nature of the industry is.
Yes. So can a company, so if we look at, for example, a car wash, for a silly example, can a car wash claim gloves, sanitizers, etc.? You don't need gloves in order to wash a car. You don't need sanitizers to
wash the inside of someone's car. Being that it's a contact thing.
This specific sanitizer, it's used not in terms of the production of the income, which is the washing of the car. So when you use your sanitizer for your guests or people that are coming in, dropping off their cars, your staff,
to sanitize your property,
to fumigate your offices, the masks that you would need to buy for your staff and hand over to your staff, can those be claimed as a deduction? Are they in the production of income?
This is interesting because on the sanitizing thing, you could also argue that, well, I need to sanitize the inside of the vehicles as much as I sanitize the people, check their temperatures, but I don't know what I might run into in the process of, generating income.
Yes.
So
it's you would need to have to
and
argue that.
I guess if it's people related, it's more understandable than if it was a place where everything is automated.
Yeah.
Because then it's like, we've got a company that comes in once a week too. So there's no, and that's just part of business.
Yes. So that's something that I thought about, and what might happen is that SARS may feel aggressive and want to deny the deductibility. So what would happen in a practical sense is you would file your tax return, you'd have your list of income, you'd have your list of expenses, you might be selected for audit, and then SARS would then run through what you've claimed.
Right.
They would, in this instance, deny, say, your gloves and your sanitizers and your mask. You would then file an objection arguing, but I need these in order to operate. And then the back and forth would then start. The objection might be denied. You can go to appeal stage.
And it's not going to happen overnight either.
It's not going to happen overnight.
Listen, even people who are fighting for millions in refunds and things, it's been a couple of years.
It's a couple of years, yes.
So be prepared to continue paying for the sanitizer and things in the meantime.
Yes.
But your luck might just change. You might be the precedent that people, you win this case. You're doing it for all of us.
You're doing it for the country. And then one final thing, True, that I want to land with is, let's look at a company that incurs a whole host of expenditure before they actually start trading.
Like what kind of company, for example?
Let's look at a company, a property company, a company that's set up in order to buy property in order to rent it out. So the company has a December year end. So at the beginning of its tax year in January, it purchases a piece of property.
A building of some kind.
A building, an uncompleted building. There's lots of renovation to be done in order to get it to the state where it can let tenants come in.
And those are out-of-pocket expenses.
Those are out-of-pocket expenses,
Got it.
Yes. So the company would then incur all of these expenses renovating. It completes the renovation, say, in May, and then it advertises this piece of properties to let, and it incurs all host of expenses, water, because you need to be paying for your water.
You need the electricity up.
Transfer costs immediately.
Transfer costs, you need security.
Yes.
You need all of it. And this is before you've got a single tenant.
Yes, before you've even advertised. And then you still have your advertising costs.
Your marketing plan,
all of that. And then you only get your first tenant in on the 1st of July. Now, technically, if we look at just the provisions of this section, expenditure actually incurred in the production of income. If we look at all the expenditure that happened before you got your tenant, that expenditure was not in the production of income, because what income? You don't even have a tenant.
Right.
And then it's only on the 1st of July.
So it's a gray area.
Yes.
Damn, and you're so out of pocket already.
Yes.
Ooh.
It's only on the 1st of July when you get your first tenant in that you can then claim all your expenses, because you've got income in which to relate all of this expenses.
Ouch. SARS can be a cruel man.
But there is light at the end of the tunnel.
I love light. So
the light at the end of the tunnel is that there is a section 11 capital A in the Income Tax Act that deals with pre-production expenses or pre-trade expenses. So if you fall within that bracket, there's a whole host of things that the company, or rather the revenue authority, would look at.
Okay.
So a trade must be carried on. So all of these expenses that you incurred before, you can only claim them once you've now embarked on your trade.
So only once you start operating.
Once you start operating, then you can claim your pre-trade expenses.
Okay.
So a trade must be carried on. The expenditure and loss must be incurred before that trade was carried on. And the expenditure and losses that you're now claiming must be in relation to that specific trade. So
AKA keep your receipts.
Keep your
receipts.
So if you started off, say, as a shoe manufacturing company,
Yes.
and then you changed into something else, unfortunately, the expenses that were incurred with regards to the shoe manufacturing company that never transpired are lost.
That's on you.
That's on you,
Okay.
yes. And then it must be qualifying expenditure. So there's a whole list of what expenditure you are allowed and not allowed to claim.
SARS is only interested in your new venture, the one that they're going to be taxing going forward.
Yes. And it must not have previously been claimed as a deduction.
Right.
Yes.
Awesome stuff, man. I think that's where we'll hold it. We'll hold it fast for the day. Quite a bit to absorb and digest. The deductibility of business expenses. What was my new word, Ganene?
Compliability.
Yes. This is so that by the time we are done with you, you will be the embodiment of compliability.
Yes.
Faniswa Mavuso from the Tax Cafe. How do they get in touch with you?
Info at thetaxcafe.co.za, telephonically on 061-874-2546. And next week is a very interesting week. It's budget week. So we are going to be
that B word we all hate, but need to use it more.
Yes.
I'm telling you.
So next week, the budget speech is actually at 2:00 in the afternoon. So in our slot,
we'll be ahead of the curve, preparing them for the budget speech.
Yes.
Perfect stuff.
Yes.
We'll see you next week. Thank you so much.
Thank you very much.
Guys, you could have been anywhere between 9 and 12, but this is where you chose to be, and for that we are eternally grateful. Thank you so much for making Moment of Truth your 9 to 12 destination. Today's Wednesday, tomorrow is Thursday. So until tomorrow, take care of yourselves so that we can take care of each other.